Just about everything we touch, every building we're in, every car we drive, it's all built on a foundation of raw materials. But here's the thing. The prices of those materials are in constant, chaotic motion. So how do the world's biggest companies even begin to manage that chaos? Well, let's break it down.
Right. We're talking about lumber, oil, chemicals, steel, you name it. These are the absolute building blocks of the global economy. And that brings us to the core problem. The businesses that depend on these things, they need stability. They crave it. But the global markets, they deliver pure, unadulterated chaos.
Okay, let's put you right in the driver's seat for a second. Imagine your entire profit margin for the whole year comes down to the price of steel. So what happens to your company, your employees, all your big plans, when that price suddenly doubles or gets cut in half? The stakes are, well, they're incredibly high.
And this gets us right to the heart of what we're talking about today, the fundamental problem of those wild price swings.
It really all boils down to this epic battle between two opposing forces. On one side, you've got businesses trying to plan their budgets months, even years in advance. And on the other, you have these global markets that can just go haywire based on a news headline, a weather report, or some political drama. That massive gap, the one between needing stability and getting volatility, that right there is what we call commodity price risk.
So how in the world do you get a handle on this stuff? You don't guess, that's for sure. You use tools. And the pros decode this risk using two really key concepts, volatility and correlation.
Okay, first up is volatility. And honestly, a great way to think about it is like the mood swings of a commodity's price. It's not about the price being good or bad, it's just a measure of how much it moves. How much does it tend to bounce around its average price?
Let's make this super real. Imagine two assets. Both start at $100. The calm one, it has a 5% volatility. It's pretty predictable, right? It mostly trades somewhere between $95 and $105. No big deal. But the erratic one, with 50% volatility, it could plummet to $50 or just skyrocket to $150 without any warning. That difference, that is everything when you're trying to run a business.
So how do we actually measure this? Well, the formal, kind of nerdy term for it is standard deviation. And this classic bell curve shows us exactly what's going on. With low volatility, the curve is really tall and skinny, which means most of the time the price stays super close to the average. But with high volatility, the curve gets flat and wide, making those crazy extreme price swings way more likely.
But here's the thing. Assets don't exist in a vacuum. And that brings us to our second amazing tool, correlation. The absolute best way to think about this is as an asset's relationship status. It tells us how the price of one thing moves in relation to another.
Do they move together like two big tech stocks when the market's on a roll? Or do they move in opposite directions, like the US dollar and gold sometimes do? Or maybe they have no relationship at all. They're just complete strangers. Understanding these connections is the absolute secret to building a diversified, tough-as-nails portfolio.
And it's all measured on this really simple scale. +1 means they move in perfect lockstep. -1 means they are perfect opposites, and a big ol' 0 means they're total strangers. What one does tells you absolutely nothing about the other.
Okay, so we have these two really powerful numbers. Volatility, which is the asset's mood, and correlation, its relationship status. But they're kind of static, right? The big question is, how do we combine them to actually look forward in time?
We do it with an incredibly powerful tool called a Monte Carlo simulation. Now, let's be clear. This thing is not a crystal ball. It doesn't predict the future. A much better way to think of it is as a possibility engine. It's designed to run thousands and thousands of different scenarios to show us the range of what could happen.
So, how does this engine actually work? Well, first, you feed it a general trend, what analysts call a drift. Then you add a dose of randomness, a shock, based on that asset's known volatility. Third, you check its relationships using correlation. So if one asset gets a shock, its buddies react just like they should. And finally, you tell the computer to do this over and over and over again, maybe 10,000 times, creating this huge map of possible outcomes.
And the result is something that analysts affectionately call a spaghetti chart. And yeah, it's exactly what it sounds like, this messy, overlapping web of thousands of lines. Each one of those lines is a single possible future for your investment. It looks a little chaotic for sure, but trust me, there is a ton of incredible information hiding in that chaos.
Which, of course, brings us to a really critical question. I mean, that spaghetti chart is great if you're a data scientist, but a CEO? A CEO needs a clear, simple answer. And this is where we distill all that beautiful complexity down into a single, powerful number.
So how do you do it? How do you possibly take 10,000 different futures and turn them into one single piece of actionable intelligence?
The answer is a metric called value at risk, or just VAR for short. It's designed to answer one very specific and very important question. In a typical worst-case scenario, how much money could I possibly lose over a specific amount of time? And that's its superpower. It just cuts through all the statistical noise and gives decision-makers one number they can actually act on.
So, for example, after all of that super complex simulation, after running through all those thousands of possible futures, the answer might just be a single number that a CEO can really wrap their head around: $10,000.
But that number is totally meaningless without its context. A full VAR statement always has three parts. First, the time horizon. In this case, it's 1 day. Second, the confidence level. We're 95% sure about this. And third, the potential loss, $10,000. But, and this is so important, here's the catch. A 95% confidence level means that on the other 5% of days, which is about 1 day a month, you fully expect to lose more than 10 grand. VAR isn't the absolute worst thing that can happen, it's just the boundary of a normal bad day.
So we have the number. We've gone all the way from total market chaos to a single, understandable risk metric. The next logical step is turning that data into action. So let's take a look at the corporate hedging playbook.
And this is just the perfect metaphor for that jump from analysis to action. All this work we've done, the volatility, the correlations, the VAR calculation, it's all just data. It's like knowing exactly where your opponent's chess pieces are on the board. That information is completely useless until you decide on a strategy and actually make a move.
And making that move in the corporate world, oh man, it's a massive operation. Before a single dollar is ever hedged, there's a mountain of setup to do. You need these master legal agreements called ISDAs with all your banking partners. Your accounting team has to navigate these incredibly complex hedge accounting rules. You need rock-solid systems and operational workflows just to track everything. And finally, you need a crystal-clear execution plan that's approved from the very top. This is the unglamorous, behind-the-scenes work that's absolutely essential to turn risk management from a cool theory into a real-world practice.
So, in the end, what we see is that price risk isn't some big, mysterious force. It's a variable. It can be measured with volatility, understood through correlation, simulated with these powerful models, and then managed with a clear-eyed VAR number. It can be planned for and defended against, which kind of leaves us with one final thought to chew on. Risk can be measured, and it can be managed, but can it ever be truly 100% eliminated?